Hello, my name is Randy Williams, proud member of Keiretsu Forum, also founder and CEO. We're fortunate to have 41 locations around the world, and I'm filming this in Mountain View in Silicon Valley. One thing unique about Keiretsu Forum, we invest in all asset classes. We have over 700 fundings. We also invest in real estate. We're going to talk and take a deep dive today on the due diligence aspects of how to invest in real estate. We're going to do 2 asset classes. I want to introduce my guest, Bing Heckman. He's been a wonderful friend for the last 25 years, but he also has spent a lot of time obviously in real estate. This is going to be an interactive program. Bing, welcome.
Randy, and first of all, I'm going to say is the due diligence is something that everyone is going to be interested in knowing that it's being done well. If you're going to invest in something, you want to know what you're investing in is credible and that risk and reward are balanced, and you've really checked out what it is that you're looking to put hard-earned money into. So with that, let me back up a little bit. My background, I worked with SRI International, did market demand and feasibility studies for new real estate development. From there, I became an appraiser, an MAI member of Appraisal Institute, which is sort of like a CPA for appraising, if you will. And you worked at appraised major properties throughout the Bay Area and the West. And then from there, I became director of acquisitions for a high net worth individual and bought properties in the western states. My pace with that group was about $100 million a year. So a lot of due diligence goes into looking at properties like that and making sure that everything is as we expect it to be when we close the escrow on those. So with that kind of due diligence background and analytical background, I'm very pleased to be part of Keiretsu Forum and hopefully be able to contribute a little bit to this community.
And speaking of that, the perfect member obviously is engaging, obviously a high net worth individual like yourself, but also participates. And we have a free Keiretsu Forum book that's over 400 pages, How to Do Due Diligence. So please reach out to Keiretsu Forum, any chapter in the world, they have it for you, or go to the Apple bookstore. And our guest today did part of the addendum, a section on real estate. Yes, it's 400 pages, How to Do Due Diligence on Deep Technology, but there's a section on real estate. And did you enjoy doing that section?
Oh, very much. Again, the idea is how do we look at things, what do we need to do, what are the questions that need to be asked, and how do we look under the rocks to make sure what we're investing in is what we want to be,
Right.
Taking those risks.
So this is interactive. He's going to ask me questions. Bing's going to ask me, and conversely, I'll be asking Bing. Now, I started Keiretsu Forum because of my lack of discipline as an investor. I was fortunate to retire from the real estate business, but quickly I wanted to get into startups. I love startups. I've made 52, as of this morning, 53 investments at Keiretsu, and I invested in a real estate opportunity today, in fact. But we're going to make this interactive. He's going to ask me questions, but my background's real estate, and I want to diversify into technology investing, which I did, but half my portfolio is still real estate. So I have a background in it, but I still like rolling the dice, and there's a lot of risk and opportunity what we do in technology, but I still like the safe harbor aspects of real estate. This is not an infomercial. This is content driven. There's a lot of risk and reward. Don't rely on any advice we say, but it's going to be very cool kind of going through this because we're going to talk about we're going to talk about 2 kind of forms. And so why don't we roll it out? Let's talk about equity and debt. We're going to be talking about 2 components because we could talk about buying homes. In fact, we had an IPO. One of our companies went NASDAQ 2 years ago, Waypoint. Very exciting IPO for us at Keiretsu Forum. We also invest in CBD, meaning Central Business District office buildings. We invest in funds. We invest in multifamily. But today we'll be talking about how to invest in funds in 2 different classes. Tell us what those classes are.
So the 2 classes, and I'm actually going to back up just a little bit. Currently, I'm also involved in real estate presently, and my role in real estate professionally is vice president of with Colliers International, and Colliers is a full-service commercial real estate company, and we're all over the world. So again, that's good access to information and all of that. So that helps. The 2 asset classes are real estate equity. So that's investing in the ownership of real estate. And then real estate loans and a particular niche within that are common for us to invest in. That niche is small balance real estate loans. And I'll explain a little bit about what that is. But I think people understand equity. It could be a single property. It could be giving money over to a developer, and they, in turn, invest in a portfolio. And so I think that's pretty clear. Randy, would you agree?
I would. In full transparency, most real estate has come to Keiretsu for the last 16 years. I personally have invested. So please ask me any questions. We're not going to be talking about who's come to Keiretsu, because we're not going to give them a plug here.
Right.
But we're going to drill down on what works, what doesn't, because I've made money and I've also lost money. So we're going to be very transparent about all those things. But let's talk about mortgage funds first,
right,
and then we'll get into equity. And typically mortgage funds come to us, and they're all over the United States. Primarily on the West Coast have been coming the last couple of years, but we're seeing more East Coast and also middle of the country opportunities. So take us through what a mortgage fund looks like, or small buildings.
And why this would be particularly of interest to our viewers. And first of all, let's put it in context. Stocks, which are referred to as equities, typically over a long period have some yield. I've heard people cite 7-8% over a long-term period. In the real estate loans that we're going to talk about, which again I think a lot of people are not familiar with, we'll explain, and also real estate equity, they tend to yield in the 9 to 16%. So big difference, but you have to understand what you're getting into. Now, the small balance real estate loans, basically what that is an individual wants to renovate a house, or maybe a couple houses, or maybe a small apartment building, or maybe a small commercial building. So this is going to be a loan size of $100,000 to maybe $1 million. Could be either side of that, but the banks don't really fund those. And the reason is there isn't an income source for monthly payments. And when you get into subdivisions, the banks start to participate in that, and that's a different category. But this smaller group, community lending, has ratcheted back since 2007, but even generally doesn't really address that market. It's a big market, and there's a lot of people who do participate in that. And as you said, it's various geography. What I like about it is instead of bonds that pay nothing, you can invest in something that's reasonably balanced risk-reward, and you're earning 9 to 16%. And it's income every month, and that I think can be very attractive, but you have to understand it. And there are funds, for example, funds in Seattle. It's migrating to Denver to expand. There's another fund from the east, southeast, Washington, D.C. to Florida, another fund in northern New Jersey, Philadelphia area. And what's nice is this is earthquake country out here. It's nice to diversify and have different regions for all of that. And again, it's developers who have something they want to renovate, maybe build new, and it's this $100,000 to $1 million plus or minus. And believe it or not, and this surprises many people, the yields on those loans to those investors is around 15%. Plus they pay points. This is, it sounds very high to a lot of people, or like it's a junk bond category. It actually is secured by like a 60 to 65% loan to value. So the value of the property, the money that's put out at any one time, would not exceed 60, 65% of the value intrinsic in that asset. And but it's a fund that's created, and investors can participate in those types of funds. I think they're very interesting. Again, I think they're not all that well understood by the general public. But that's one of the things we look at. Now, again, due diligence is a key topic here. How do you look at these? How do you look at the equity funds? And how do you understand what they're doing? Are they credible? What are the risks? What are the issues? What are the questions you need to ask? These.
And let's drill down on that. And the spirit of what we do at Keiretsu is there's no vested interest when you do make an investment. If you're a member, 100% of your dollars flows to the entrepreneur, and there's no fees back to us. So that's very important. So when you get knowledge from people, make sure, what are they getting? I mean, we're a membership community around the world, so you pay a small membership to be part of the community, but you enjoy swarm intelligence, the mind share. Again, why I started Keiretsu, I needed smarter people around me. So selfishly, my goal was to get 100 of us here in Silicon Valley, when we look at an opportunity, we will get unvested interest, including for myself, because I'm not getting paid if one of our members goes into it. But it's very cool to enjoy the Swarm Intelligence. And getting back to our Keiretsu Forum due diligence booklet, please look at that, and that's available many sources. Apple bookstores, or go to the investment page at Keiretsu Forum, you'll see it. But also get involved and come to a forum. Wherever you are throughout the world, we're fortunate to have 41 locations. So let's drill down why we make an investment like this. I also personally, this is how I like to put in my retirement dollars into the mortgage funds.
Right.
Why is that important instead of putting ordinary dollars into these mortgage funds?
That's a great question. And first of all, a lot of these funds qualify for being placed in an IRA or retirement account. The IRA retirement accounts, as you know, are not taxed. The income that's made in that is not taxed until you start taking the money out. So you can grow that fund, you can grow those qualified funds and not pay taxes on them. The mortgage loan funds are taxed. If they're not in a qualified account, they're taxed as ordinary income. There's not a capital gain or appreciation. There's not a depreciation shelter. It's income from a loan, taxed as ordinary income. So yes, great to put in a qualified account, because when you're earning 10, 12, 15%, it's better not to be paying taxes on that, and it's a great way to grow an IRA fund.
One correction, you will pay tax on it.
When you take it out.
Whenever you take it out, or when you're 70 and a half. And again, we're not giving tax advice, but that's how I personally like investing in the mortgage instruments. When you're talking about equity, we'll talk about other ways to invest.
Right.
So, irrespective of it's a mortgage fund, and or a fund that's investing in equity, or hybrid, doing both, I like to look at the jockey, i.e. the CEO. I like to drill down the team. Sometimes I make investments. I do a site visit, which is critically important. Look at books, which is critically important. But also see if, in fact, they're engaged, they have expertise. I also made investments to see. I had one firm had 40 employees. I was seeing if they were having fun.
Right.
Are they making money and having fun? Are they getting along? Are they getting along with the CEO, they're getting along with other team members. So number one is the jockey. CEO is critically important for me. And then I ask her or him, the CEO, what type of track record. Track record is critically important.
Absolutely. For these small balance real estate funds, track record is absolutely key. Have they had any defaults? Have they had any late payments? Have they had, and these are not funds that just start up and don't have a history. These are funds with a history. These are operators with a history, and knowing how they've done, as you know, is very important.
I hate to say this, but we're filming this December of 2015, and I think it's pretty difficult in this environment, especially on the West Coast or Silicon Valley, to screw things up. So high tide floats all boats, and so I'm making investments with folks, but the redemption is very interesting to me. So let's talk about redemption. So
redemption is getting your money back.
Right. And so some are 1 day, some are 2 years. What do you think about redemptions? Meaning you invest $100,000 with an opportunity with a fund, and you will sign documents, and the documents stipulate that you can ask and call for your money back, but it will take a period of time. 6 months, 2 years. You care about redemption.
Oh, absolutely. And one of the nice things about small balance real estate loan funds, typically the operator, if you really need the money, they'll get it to you within 30 days. Normally, you would sign up and agree, I'm going to keep it there for a year, maybe 2 years, and then you can get it back within a fairly short period of time. These are loans that are 6 months, 9 months, maybe a year. So it's easy for them. They have a constant turnover and flow, so they can get you your money back. And that contrasts with the equity investment, because your funds are in there. They need to be in there for 5 to 10 years. That's just the way it works, and we'll talk about that more later. But the nice thing about these loan funds is the fact that you get your money back. You're not tying it up. The other piece is, everybody expects, the memory of a recession is still in everybody's mind. When's the next one going to hit? How's it going to affect everything? We're all a little anxious about that, having been through this great recession. And if you're at a 65%, 60% loan-to-value ratio, you get some hints that things aren't going well. And at that point, you can start seeing, because all these funds typically have a portal where you can go in and look and see the progress, the payments, the repayments, the underwriting, how things are going in real time. And if things start to get a little squirrely, you can pull your money out and deal with things.
So this interactive program, you brought up 2 points are critically important. First of all, communication. If you're going to be investing with anybody out there, make sure they have great dashboard technology. They communicate. They communicate not only
Gotta love the internet.
communicate what's going on good, but what the problems are. We need to know everything. Okay, getting back to loan to value, 65% LTV, loan to value ratio. So some people don't have the appetite for 65%. We had a very cool mortgage fund came to us last year. One of our members, and that's the whole spirit of Keiretsu, the members get involved, and actually he got some legal advice, and they went back and they split the tranche up. He wanted 40% loan to value ratio or below, protect his retirement money.
Right.
There's no protection of any money when you invest, but that is probably one of the, I won't say sure, but that's a way to mitigate a lot of risk, and he wanted 7%. And then the B tranche was up to 65.
Right.
And so this gentleman, the CEO of the company, said, great, I'll offer Keiretsu Forum members an AB. AB under 40% or B close to 65%, but a higher return. I took both, A and B,
right,
and then I convert over B because I happens this year want to take a little more risk and juice up my returns. I don't know if you invested. We're not going to tell you what company this is, but did you look at this structure?
Yeah, and that brings actually into another topic that I want you to help me to make clear here, and that is, in effect, let's say you're making a loan at 15%, and you come in and say, listen, I don't really want that full exposure. Give me a partial exposure, and for that, I'll take 7%. Meanwhile, he's lending at 15%, paying you 7%. That means his other borrowers, that's to say his B tranche investors, are now not just getting the 15%, they're getting the benefit of the leverage. You get the security, the other investors get an 18% rate of return. That's an interesting trade-off. Now, some of these small balance real estate funds are cash only. There's no leverage with the fund. So it's hard to understand that a loan fund can itself borrow money and have leverage for its fund. So let's say they have $20 million out. They might borrow $10 million, and if they borrow that at 7% and their $20 million is making 15%, that's a more aggressive fund, but if you understand the manager, you understand the properties and the underwriting and all of that, that could be a right fit for an investor looking for above average returns.
Okay, good. Half the program's over. We're going to drill down in equity. But before we leave the debt structure, I want any viewers to see this, is if you have leverage, i.e. leverage of a community, for instance, if we have 200 or 300 investors investing in a mortgage fund, we will dictate terms. Individually, it's hard for you to dictate terms. But if you can, do it. Because look at the terms very carefully, and don't accept, 70, 75, 80% LTV, because that's dangerous. But, drill down the term. Unfortunately, we've been around the block, and over 150 million has been given to real estate entities that have come to Keiretsu Forum. And so we know a lot about structure. We know a lot about obviously making money, but we've also lost money. And so we know where the pitfalls are now. So let's drill down on equity. So tell us what equity. Give us a definition of what we're going to be talking about now.
So again, all of these funds, you want to look at the developer, you want to look at the strategies, you want to look at the underwriting. I'm going to say one thing about the due diligence in the small balance real estate loan. I'm right now conducting due diligence on a fund, and I'm looking at every document that helps in the underwriting decision for that loan. The appraisal, the financial information on the borrower, the information on the property, the title, making sure they have insurance, making sure all the bases are covered. That's a lot of work. And one of the things that Keiretsu does is you have a community where some people do a fair amount of work that an individual just simply could not do.
And also, this is all pro bono. Our members, put an oar in the water. We got a great expertise, and so we might, be doing a due diligence on, pick a subject, on women's shoes or wine, or and guess what? We've had women's shoes presented to us.
That's right.
Shoes out of Portland. But so the whole spirit of Keiretsu is hopefully 8 to 15 people put oar in the water, help out. Now, the project you're working on, thank you so much. How's it going? Are you moving toward getting a due diligence booklet together?
Yeah, and we'll hopefully have that just kind of around the first of the year, first week of January, something like that. soon, and it's a great committee. Really enjoy working with others, and everybody has a little thing that they're doing, and it comes together. It's great.
And as a founder, all I can do is say thank you so much for getting involved. Again, this is all pro bono. Our members are, with great expertise, are giving their knowledge with no solicitation and giving that information. In fact, other angel groups or other iBanks on the technology side or VCs love to see our due diligence. We are an open source community. Let's give it out. So, equity.
So equity, there's a lot of examples of equity. Typically, you are a group of people are providing funds to a developer, manager who then goes out and buys properties. It might be a single property that they have teed up that they say, okay, let's buy this property. This is a great opportunity. It might be a strategy. It might be, often these funds try to play in a niche that's higher than the individual private investor, but lower than the big institutional funds. Typically, that ranges from about 7 to 20 million. Once you get above 7, 10, the individual private, there are fewer of them. Not that they're not there. There are some, absolutely, but there's fewer. And then the institutional guys like the 15 million and up because it just, that's how they want to work efficiently. They like bigger projects. So one of the strategies they play in that, it might be apartments, it might be shopping centers, it might be whatever. Then there's geography where they would really focused. Might be something like self-storage. So there's senior housing is another one. So there's different strategies.
Yeah, and historically, Keiretsu Forums love multifamily because you have obviously tenant base, and usually most of the things come to us are 92, 95, 94% occupied, so a little risk is baked out. But again, the mortgage funds are paying us monthly. Sometimes we want to accrue it. That's fine. You can put it and accrue it and get a little more interest.
Right.
This is your betting on the come.
Right.
And then there's a life cycle of 3 to 5 years to liquidate whatever they're buying. Let's say they bought a portfolio.
And it can be longer with these funds especially.
Sure. Let's say they bought a portfolio, or we're going to say they're going to be buying a portfolio of multifamily throughout the United States.
Right.
This is their business plan. This is what they're going to be doing, and they're going to be liquidating 4 to 7 or 8 years.
Right.
So most of the equity or the return is
capital gain.
Capital gain, and also a return of principal.
Right.
And then generally they're giving us a preferred return.
Right.
And then a profit participation. So let's talk about let's dumb it down. Let's just talk one asset class. What asset class do you want to talk about?
In terms of the inequity?
Yeah.
Let's just take apartments. That's a very common one.
Okay, tell us about the perfect structure for you as an investor.
So what they might do is have an 8% preferred return, and then after that 8% is delivered, and that's on a cumulative basis.
After money's given back.
After the money's given back.
You invest $100,000, you get 8% return.
Then the developer, manager, whomever would get 20%, and the investors would get 80%. Sometimes it's 30, 70, whatever that ratio might be. It's called a waterfall. Once they get over that hump, there's a waterfall that flows to the investor and to the manager, so forth. Now, manager fees are very important, and for many developers, their approach is, I want a feasibility project, which is to say the ability to generate fees. Well, we try to avoid that. We look for balanced fees. That is to say, there might be a well-earned fee for managing, just property management. There might be an asset management overview fee. So you have to look at all of these in combination, but the basic structure is a preferred return and then a waterfall to the investor and to the developer. And that's a great return, a great structure. And then you also want to see what's the track record of the developers. You mentioned at the outset, you want to see the strategy. Is it a market? There's one that really likes Kansas City. That could be, you get to understand the community. You can see why that might be. You wouldn't think of it, right off the bat, but it could be a good idea. Then workforce housing is another one. Apartments that are designed not at the upper end, but really for the mid-range, nice apartments, and then take that concept and apply it to seniors. We have an aging population, and not everybody owns their home when they're in their 60s and 70s, and that's a great market that's growing, and somebody's seeing that opportunity and taking advantage.
We've had a great group that has brought us kind of hybrid senior housing. So the perfect opportunity for me, if I'm going to invest in my equity dollars versus ordinary dollars, meaning I want tax write-off on that money, I will look at a multifamily.
Depreciation provides a tax shelter for the equity investments, unlike the balance, unlike the lending investments.
So if I invest $100,000, generally I want a pref of 6 to 9%. Generally I get 7 to 8, and so I'll get my $100,000 back, hopefully.
Right. And
then what happens? A preferred return happens, and what happens is that generally most of the things I'm investing in, there's liquidation. Let's say they bought a apartment at 89%, they move it up to 98% occupancy, and they put a lot of value. They raise rents, and obviously the cap rate changes, and there's profit there. So they will distribute the profits.
Right.
Not early, but on sale, and then you have an orderly liquidation. So typically, Bing, when you invest in the equity side, when do you see your first return of principal?
Right. So let's review the process again. They might buy an asset, they might do some renovation, they might bring in some more sophisticated management, they might take it to another level. They might take it from this mid-range niche that I spoke about earlier to an institutional quality and have another market that they can deliver it to. But usually that's 3 to 5 years out from day one. That's when it starts to roll. The first 1, 2, and 3 years is when the properties are acquired. Then they're managed and renovated and so forth. Then they become seasoned, and then that is years 4, 5, 6, 7, 8. And it depends where you are in the economic cycle too, because you might want to ride that a little further. And
well, we have one more minute, and I need to conclude personally in 30 seconds. But I'd like to have you say for 30 seconds, what have you enjoyed about Keiretsu, and how have you done swarm intelligence with a community to look at real estate as an asset class to invest in?
Well, first of all, there are so many interesting people, interesting enterprises. For me, it's a little bit like a kid in a candy store. I just really enjoy seeing what all is out there, the new trends, and then working with the people, a lot of very capable people. And it's really nice to do a job where you feel like it's getting done well. And at the other end of that, you feel confident in having a nice, diversified set of opportunities to invest in that you feel good about.
Well, I'm very proud to have Bing on the show. He's been a wonderful friend the last 25 years, but it's great that he decided he loved Keiretsu Forum a couple years because he wanted to diversify. You're a technology investor, but you're also obviously very much involved in investing in real estate. So Keiretsu Forum presents. This is our third show, moving on 4th in January. Please, if you're interested, come to Keiretsu Forum or any other chapters around the world and say you'd like to see this content. How else would they find this content?
The content that Keiretsu Forum offers, there might be some groups that do similar kinds of things. I would have to say nothing with the sophistication of Keiretsu Forum, my personal observation.
So you can go on YouTube and see, just go ahead and do Siri and say Keiretsu Forum Presents. You'll come up to our shows, and every month we're going to have a show, or come to Keiretsu Forum throughout the world, and we have 41 chapters. Fortunate, just launched Jakarta and Prague, and also 6 months ago we opened up India with Chennai and Bangalore. Thank you so much.
Thank you, Randy.